All right, stock market analysis and projections. Important information before I get into this. Please do take a moment to read this slide. It's about our approach to analysis and about how you use the analysis that we share and the important aspect of trade ownership. You must own your own trades. I want to remind you about our level 1 special, 1 month non-recurring, $10. You're going to get everything that's on this page. If you're just now tuning in or watching a clip of the stock market analysis, go back, watch the whole show, because we have great things earlier in the show, and watch Matt's presentation on this, and you'll get a good sense for everything that we're offering for $10. You won't believe it. Non-recurring, sign up. If you don't like it, well, it's not going to renew. And if you love it, well, you can choose to come back at any level that we have available. So please do look at this level 1 special if you're brand new and not a member, or if you're a free member. All right, stock market, multiple time frame analysis and projections. I'm going to look at the SPY, weekly, daily, intraday, and really review our proprietary indicators as we move forward. So let's first look at this. This is our market conditions monitor. I'm looking at the pro version, and this is a really important information as it looks at the algorithms that we have built into it. And I have this set to short term right over here in the trader view. The other view is time frame view that's there. We'll stay on short term right now because the short term is telling us that you're either very bullish or bullish, looking at SPY, QQQ, IWM, or DAI. They're in that very bullish conditions. So no matter if a correction is anticipated, there's really no reason based on everything that we look at to be short yet, because the market's not telling us so. Even if you look at the near term, which has got really short-term inputs there, it shows you very bullish. And the only thing that's changing is the IWM right now, which has turned to neutral. So these are actually dated changes when these changed, because there's very short-term inputs on here. And you can see that the IWM now has turned neutral on the near term. Very short-term information there. Here's the short term right there. And the intermediate term, as you could see, all very bullish when you look at that. So now there's been no reason to believe the market was going to fail yet, no matter about valuations, no matter about cyclical corrections, any of those things. It's important to refer to this first before you really get into the chart analysis and have that bias. The market is telling you it's really strong. And now let's look at that on the charts and look at what the first information might be that would be changing on that. So let's switch over to the charts right now, and we will look at, let me just put this down. And let's start out by looking at the VIX first, because we had some people that have asked about the VIX. And we have been, let me just go to the weekly first. We have been in a period of an elevated VIX. It's very unusual for the VIX to be elevated at a time frame when the stock market is super strong. And of course, what's going on are two things. That is the Middle East tensions and the election coming. And when you look right over here at these cycles, it's the rhythms in here are just outstanding. And right in here is where we're looking for the market to begin to price in much higher risk, much higher volatility right there. And since it's already elevated, it really has me asking the question, as you can see right over here, we have IVs rising. Is the stock market actually peaking? Is that what's going on as it's rising? And investors just starting to buy insurance for what they believe will be a period where there is selling coming into the stock market. Now, this is where those sink troughs are around mid-October. We've had this timing in here for a long, long period of time, believing that the market would continue to move up until mid-October. Now, when I switch over to the daily chart right over here, you can see there are two out-of-phase cycles in here. So one that you can see the trough right there, and you could see the trough there, and you could see the trough there, and one potentially here. So here is the first timing right here in this window that you can see where implied volatilities could be moving up. It actually might wait to here. And interestingly, when this cycle right there has its trough is on the 4th of November, right around election day. So we believe that IVs will be moving up sharply, either starting any minute or maybe chop around in here and then not really have a real blast off until after the election. So looking at the VIX, it says to us, be careful. We're getting into a time period right in here on that weekly chart where it's very likely that you're going to have a sharp upside move in IVs. I think they're easily going to be into the mid 30s, but we could see 40s and 50s depending on how sharp a market corrective period is. So I wanted to look at that first because looking at market conditions first says to us the market's very strong. Looking at implied volatilities now has them elevated, but the cycle patterns say not quite ready to move to the upside in implied volatilities, though very soon. Now let's switch over to the charts. And what I have here on these charts are, let me just get my pointers available. On the weekly chart right over here, weekly, and here we have daily, and here we have daily momentum. And here we have the 2-hour, which I'm going to show you something very different than the 2-hour because it can be a good tip off for when the market is making a peak. So right now, you'll notice something a little bit different in here, and that is based on a question presented by my team. The question is, wow, all of these things are so incredibly strong, and the market's been this bullish. Should we actually be showing the downside projections versus just maybe showing the period of risk? Because I don't really have an anchor point up here on the top to be able to project to what levels it's going to be moving to on the downside. So what I've had in here, and I'm just going to grab this, is a projection down into here, into that midpoint right there. And that's what the chart has looked like to this point, up to that. Now you can see that, this is very likely to be where the correction comes in there. The question is, and my level 3, level 4 members can answer it, would you rather see the projections to complete the cycle as we have always done? Or would you rather that we wait until the conditions are negative and then have it look like this? And then once it turns negative, then put in the projections. We'd still show the periods of risk. We'd still show the momentum. We'd still show all of that. The only difference is that we wouldn't project to the downside until the conditions tell us such. And I think that's a very, very interesting question because it could be deceptive. I'm showing, we show a downside move when everything points to the upside still. So we want to really make sure that we give you the most valuable information at the time and then put the projections in when it is most important. So I see interest. I see right now the answers coming in on the Q&A that says, yes, leave those in there. And I really want to hear through email or more answers of whether or not it makes sense to wait or not in here. In the meantime, we are looking for that period in here of correction. As you see right over here, it was the final 3 weeks that the biggest decline came right over there. And if I go back into these other cycles right here, you can see that it's always right towards the end where the market gives way in a very big way and then have these declines. So that's where we are right now without no peak yet. And no reason to believe yet that the market's going to go down, other than it's at historically high valuations, and that the normal cyclical movement would then have it pointing to the correction, which is very, very likely coming. You see in here the note, potential large drop, Q3 or Q4 or together, and that's what I believe is the highest probability. So supports right now 557. Right over here is about 550 on the SPY. Then we get into this lower support and the dominant support down over here, which is 540. This is 531. And, to get a 10% decline, which is quite reasonable, you'd lose 58 points, 59 points, which would take you down into the 530s, which is somewhere down over here. Now, when you look at that and you want to project out into the longer term, you can see or see why we have believed that the bull market couldn't end until sometime next year, maybe early next year, maybe somewhere in the first quarter or late first quarter, looking at this. So whatever decline comes in here, it seems like it would be quite viable, and that the next rally would take you to even higher, extreme, ridiculous valuations on the upside. And I'll never stop saying that because, again, I traded the Nifty 50, I traded the .coms, and I know that eventually those leaders that are going to that are driving the market up will go away, and we'll get a real bear market that comes after that. But in the meantime, this looks like a pullback in here. We'll call it maybe 6 to 10%. And then another move to new highs over there. That's your intermediate term outlook looking at that. I'm getting more on the coming in on the Q&A that says leave those downside projections in there. That completes the cycle. So that's interesting. So now here we are on the daily, and you could see these vertical lines are the actual place that these cycles have their troughs. And this is the cycle patterns right in here. The cycle's been shortening a little bit. And for our members on the SPX chart, you will see the cycle counts are added in there. And this was a low. This was only at around 21 days off of this low right here. And these were been, 23, 21 days. So this cycle bracket is now shortened from what was 24 to 22 bars, as you can see. I want you to note the option bias indicator. Katie showed that earlier on in the show. It's extremely valuable in telling you, if you're an option trader, to keep your positions biased with the OBI, the options bias indicator. I developed this back in the time that I was on Tasty Trade because, and believe me, I love those guys. They're great friends of mine, Scott and Tom, and so many that are there. But they do teach you to be short options. And when I was there, traders were writing to me, they're getting run over by being short options, puts or calls, depending on when it is. I wanted to develop an indicator that could help you avoid that so that you would not get run over by the market. I know lots of people right now have been shorting options and getting run over by the market. This helps you a lot with that. And you can see that it's still strong. Right over here, you could see our both the slim ribbon and the reversal scout are positive, and that gives you a sense for how strong this is. This was a swamped cycle. So what happens is that because the upward pressure from the weekly is so powerful, as you see here, what happens is that the correction right in here becomes rectangular because you have the downward force here, which is less of a force than the upward force that you have on the weekly chart. And it gives you downward pressure and upward pressure meeting each other, and the correction is sideways. And this stays very positive. And that is a very, very good indication that once it breaks out above the cycle peak, that is then, your next upside move, which occurred right in here. Here's your minor supports right in here. The zone is about 578 to 573 on the downside right now. Now, notice this question here. Which cycle makes the weekly trough? So the weekly trough, I'm going back to weekly, it's very obvious that it has not occurred yet. So that is, I think, important. Now, I got a question from a level 4 member that I think is worth bringing right now and talking about, and that is about the monthly pattern. And if it's possible that we were looking for a minor monthly low, if that actually happened already. And I'm going to show you why the odds are small that happened. Here is your monthly chart on the S&P 500. And the question is, could that have happened already? That would have happened right here. That decline is that decline that occurred with the yen panic right there, and then the market moved up again. As you could see, I'm projecting for that trough to still occur. In other words, that pullback to occur in this November-December period on the monthly chart. Let me show you why I believe that the probabilities are small that this low has occurred already. And that's because of cycle analysis theory, which I teach in the cycle analysis workshop. And this low right over here occurred at a time that does not align with the weekly. So her question was exactly based on the principle of variation. Could the variation have made the low here versus right over here? And I'm going to show you why that's not the case. And this might be way too technical for a lot of people watching this show right now. But that low would have occurred right over here. That's that yen panic low, which exactly comes onto this minor cycle low. But the dominant cycle low is way out over here that we've been projecting. The principle of synchronicity says that wave price movements are phased to cause simultaneous troughs. This would not match up with the dominant cycle as a simultaneous trough. That says that the principle of synchronicity says that the trough is out over here in November or December. So I wanted to answer that question before moving on, because it really talks to the fact that the next 2 months could see a sizable move to the downside. If this ends up to be that monthly trough right over there, it will mean that there's a dominant shift that went on, and we will be looking at this potentially as where that dominant cycle is. That is a very low probability. So right now we have to stick to the highest probability that the principle of synchronicity says, and that is monthly and weekly will have its trough out over here in November or December. I have a question on the OBI. Is that a level 3 or 4? That is a level 4. You can have it live on the Thinkorswim platform. RV showed earlier that we do illustrate it on some of the other charts. So you have any questions on that, right? I'm sorry, Matt showed it. Write to Matt at askSlim.com, and he'll answer any of those questions for you on the OBI. But it is a very important indicator for you to have. Here's the question: which of these cycles will make the weekly trough? This cycle right over here ends about the first or second week of November. So that would make, once this peak is in place, the pull back into first or second week of November. This cycle right over here ends first or second week of December. Now, when we went through all the charts earlier, RV and Katie were showing quite a number of stocks that had important troughs in December. So that helps me with this analysis in saying that, I really think there's a pretty good probability that this cycle is going to be the one that has the biggest decline, and that what will happen would be that you get some kind of a positive translation in this cycle right over here, some kind of a decline. It moves up right in here, and then this is your biggest decline right in here into that December timeframe. So that's the way I would project it right now, though there is still a possibility that the big downside move comes in this period in November. I don't know which of these will end up to give you the trough, but I still think that's coming out there in the November-December period. Now let's look at the momentum conditions, and you can see momentum is very strong on the SPY. And you can see on here the slim ribbon PO right over here. It gave you momentum signals that said it's going to resume on the upside, and that's exactly what it did right over here. Now I'm going to switch to a 2-hour chart and show you something that's a little bit different. Those of you that took the cycle analysis workshop, in module 17, I talk about this right there, which is the detrended price oscillator. Essentially, what it does is it takes trend out of the action. And it is one of the best ways to identify cycles, because it essentially takes the trend out, leaves cycles in, is what it does. Now what I've done is I've taken the 2-hour chart and I've added the daily cycle brackets onto it. So you could see that this actually is a daily cycle. This was your daily cycle. This is the rising phase we're in right now. That is beautifully clear when you look at this. Now, how am I going to use this oscillator? Well, first of all, you could see where it gives you that sense for how those cycles are defined in there. It also has a little minor cycle designation in each of them, as you see right over here, which helps you also see the minor cycle. I'm going to use a tool that I don't often show you, but it's one that I think is very valuable because it's dynamic as you use it. If I look at this cycle trough right over here and look at the first cycle using this, it's a linear regression channel. If I go from trough to trough, you can see the condition of that first half of the cycle right there. Looks very clear. It's quite positive. If I go to the next trough here, you can actually see as this turns downward, and it gives you the sense that, well, until you get to the bottom of that next cycle, that's negative. And it would give you a good reason to believe that you can actually trade the short side there. And of course, when you look at the slim ribbon PO on the bottom, it's actually red during that period, red to neutral right over there. Let's look at the next cycle. Let's go from trough to trough right here as we look at the minor cycle right there, and it looks positive. And you can see right over here as it dynamically begins to turn down to that next trough that's showing us right here. And there's that declining phase right over there, very visible. So this is actually stuff that it's very advanced teaching, but I wanted to show you this because it gives you such a great sense for how to use some of these other tools in a way to really understand market conditions. And you could see in here while the slim ribbon PO turned negative during that period right over there. Let's look at that next daily cycle right in here. It was really strong. It's hard to identify that trough. I don't really see a good one. Probably is right here, and you can see it points up. Now, I showed on the daily chart, let's go back here, that this was a swamped area right over there where the market could hardly fall. Let's go back here to that minor low, and you can see this thing never really turned down. It was just really sideways the whole way until you got to the trough. So there's that upward and downward pressure meeting with each other. Now, where are we right now? Well, I'm going to add a little more time on here. I'm going to change the right expansion to about 35. And move this over. Why didn't that change? There it is right there. So you can see in here that there's this minor cycle right in here that is likely to bring you some kind of a pullback. Let's look for where this trough is right around here. And you could see this is still moving to the upside. And based on everything I'm showing you here, as I'll just zoom in on this last one. Whoops, I blew that. Let me see if I can get that correct. Right in here, that's showing you that, the slim ribbon PO is giving you resumption signals. Your linear regression channel is still pointing up, and everything is saying it's okay. Now, once you get a designation of this low in here, if it happens to be, below the last cycle low, which is right over here, then you'll know that there's a breakdown and that the market is weak, and this will be turning down already. In the meantime, this is telling you there's no reason to be short yet, because on top of the indicators that we're looking at, this linear regression, which gives you a channel set up, I believe it's a 1 standard deviation, is telling you that the sum of all the data from this cycle low to where we are right now is to the upside. That's what this all looks at. And this, you can see, is just a phenomenal way to be looking at the market conditions based cyclically on this 2-hour chart, which has the daily information put over it. So I wanted to do that type of analysis, that type of teaching, because I want to show you that you can get a sense for when the market's actually turning over through an assortment of tools. Our slim ribbon PO on the bottom will turn red. It will tell you when it's negative in there. You will get the OBI over here turning red or going neutral, as it did right over here You can't see the yellow. It's a little hard to see before the market then turned negative right over here and gave you that big decline. So these tools really help you with that. And again, there's a decline due into November or December, but nothing yet is telling us that the time for that is now. The time for that is soon, based on what we're looking at, but we don't want to jump the gun, because what will happen is that you will burn your emotional capital. If you do so, you'll lose money. You won't be able to pull the trigger easily when that time does come. And what we want to do is stay really strong. I used this analogy back a few weeks ago. I know Matt loved it. And that is, you want to be that, lion that's in the tall grass, waiting to pounce on the prey when the time is right to do it. So you don't miss that prey. Because if you get up too soon, if the lion gets up too soon, then the prey gets scared and runs away. Let's be very, very stealthy and wait for the right moment to get on what we think is going to be a big decline. Don't burn your capital. Don't burn your emotional capital.